Today's lecture, we are going to be going through the time value of money, which is investment decisions. So before I commence with the lecture, I just want to give you a brief understanding of what time value of money means. Time value of money specifically means that at a specific time, your money or your investment is worth a specific amount. So the sum of money that is worth more now may not specifically be worth the same value at a future date. Hence, we call it time value of money. As we progress along the lecture, just understand you may come across terms that may sound very difficult to interpret, but bring yourself back to the definition. All we're doing is we present valuing money or an investment that you have now that you want to understand how much it can be redeemed in the future. In the same concept, you could have an investment that's in the future where it's given a future value. However, you want to know what it is going to be worth in the current day. So moving on, what are our outcomes? For today's lecture, we want to be able to understand the concepts of cash flow and the time value of money. As I said to you, the time value of money is specifically a sum of money in the hand at this present moment may have a greater value when it's paid in the future, or it may have an amount less than in the future. We also want to calculate interest. Why do we want to calculate interest? Can anybody tell me why? Why would you want to calculate interest? When we talk about a specific amount of money that you have invested today, so you've got amount invested today, you want to add to it something, and then it's going to equal to the future value. Normally, we would add interest in order for it to accumulate and to understand what the future value is. That's the reason why we want to calculate interest. We also want to calculate the time value of money. As I said to you, what is the future value? When we talk about future value, we talk about discounting it. Why do we say discount? What do you understand of the word discount? What can you tell me? What do you understand of the word discount? If you go to the shop and you're given a discount, what does that mean? Please don't feel afraid in my lectures to unmute yourself or to chat. The only way we all can learn is if we verbalize. And remember, if you verbalize and if you understand, then there's less work for you in going back and re-understanding and re-listening to the recording. So what do you understand by discounting? Nobody's been given a discount. I'm not moving on until somebody speaks. Thank you. Thanks, Oluwetu. It means you're paying less of what it is worth. But when we talk about, remember here, if your future value, I'm going to give you an example. Now, Oluwetu said it's given you something where you pay less than what it's worth. You could have, am I right? So this is where we say we either discount. Why? Because what you're going to get in the future. So discounting is a process of determining the present value of a payment. Like you could have a stream of payments. Say, for example, you've taken up an investment and you've got a stream of money. You've got a stream of money that you're paying monthly, and you're going to be receiving this money in a whole lump sum in the future. So what rand is worth more today could be more, as I said to you, could be worth less in the future. So discounting is a primary factor when you use in the calculation, in pricing that stream of income that you're going to be paid for the value that it's going to be worth in the future. Now, remember, when you hear the word discount, always remember what Oluwetu told us today. It might be in 9 out of 10 times, it's worth less than what it's worth. Why? Because obviously what you have today, you can purchase for much more. If you in the future, in 6 months' time, you are given the same value of money, you might not necessarily be able to apply that and buy whatever you have bought in today's age. Now, you tell me why. Why can you not be able to buy that amount of goods, for example? Now, I'm giving you primary factors and I'm giving you very elementary information. When we progress along the section, it's not going to look difficult. It's not going to make you feel intimidated when you see annuities and present valuing, etc., etc. Why would you not be able to buy as much in the future?
Because of inflation.
Yes, 100%. Now, you know, you've done have you done economics? Okay, for those of you that have done economics, you know that there's inflationary factors, there's factors of economics that comes into account, there's factors of the price index, etc. You will always be worth more today than you are in the future, provided that you in an economy that is in normal circumstances. If you're hyperinflationary, it will be totally the opposite, in the sense that you will obviously be able to buy more. Thank you. Now we're going on to understanding the concepts. Now, if you look at the screen, I've tried to downsize it. Let me put it on to, okay. Okay, can everybody see my screen? I'm now going to be explaining to you what are the terminologies. So a single cash flow, I've highlighted the word single. It means you make a once-off investment. What is an annuity? An annuity, as I said to you, it's a stream of equal payments that you're making. So say, for example, you take on a unit trust. A unit trust, for that matter, would require you to make a payment every, say, for 12 months, you're making payments of 100 Rand each month. So it's equal amounts that are paid at equal intervals. What is an ordinary annuity? The reason why it's called ordinary annuity, it's by its very name. It's just an annuity where payments take place at the end of each period. It's the same time, it's the same amount, and interest is calculated in the same manner. What is an annuity due? An annuity due is where payment is due at the beginning of the period. So say, for example, you go to an insurance broker and you want to take on an annuity where you pay a certain amount and you're going to get a specific return back. Hence, you will then go and purchase the annuity, depending on whether it's a single cash flow, ordinary annuity, or an annuity due. And once you take up that option, if you chose the option of annuity due, it means that you're going to be debited off your bank account at the beginning of the period. When we say at the beginning of the period, what does that mean? You're paying in advance. Compounding. Now, compounding, just by its very word, compound means to put one on top of the other. It means to add to it. So whenever you look at the word compound, it means that I have 100 Rand today. In month 1, I have earned 10 Rand interest. How much of interest do I have at the end of the first month added to my annuity? Who can tell me? So I have 100 Rand, which is the principal amount. And then I'm adding that 10 Rand to it. How much do I have in total? Speak to me. So I have an annuity that I've invested. Initially, I've put in 100 Rand. I then earned interest on that 100 Rand of 10 Rand. In total, how much do I have?
R110.
Yes, thank you. Now, what does compounding mean? Who said to me 110 Rand? So what does compounding mean? It means that at the end of month 1, starting in month 2, instead of you earning interest only on 100 Rand, I'm going to start earning interest on 110 Rand. So that's what compounding means. So at the end of month 2, I've earned interest of 10 Rand. At the beginning of month 3, I have 120 Rand that I'm going to be investing. Now, what does that mean for interest that I'm earning? What does that mean? My interest is going to be what? Come, students, the quicker you answer the questions, the more quicker we can move along.
10 Rands.
Sorry, say that again.
The interest is going to be 10 Rands, I think.
The interest is going to be?
10 Rands.
Yeah, it's going to be 10 Rand only for month 1. But remember now, you took 110 Rand at the end of month 1 and you reinvested. You're earning interest now on 110 Rand, not just 100 Rand. So what does it mean? Yes, Oluwetu, the interest is going to increase. Who doesn't understand it? I'm going to take you to an Excel spreadsheet because I want you to understand the idea of so students, I want you to understand the idea of investing. So this is my investment, right? So say, for example, this is your ACC 103 student, and this is your investment, this column here. And this is my interest. So this is my capital, and this is my interest. The bank said to you, or wherever the house that you have gone to, the financing house says that I will pay you 10% interest, right? So we have interest at 10%. Okay. Going to bring you back to this when we're doing our examples. Okay, you have 100 Rand interest for month 1. Here you go. For month 1, it's 10% interest for the year now. So I'm dividing it by 12. Can you understand what I've done here? So you've earned 83 cents worth of interest for that first month. In total, okay, let's make it easy with the example that I have. used. So you've earned 10 Rand interest. So ignore this interest here. I'm making it easy for you. You've earned 110 Rand. Now, starting in month 2, what is my capital? We're talking about compound interest. Compound. Remember I said to you, compound, the word means one on top of the other. When you compound, it's going to be, you're starting month 2 off with a capital amount of 110 Rand. My interest is 10 Rand. I've now got a total amount of 120 Rand. So here I've made it easy. I don't want to overcomplicate it for you. I want you to understand that for each month, my capital is increasing. Can you understand what compounding now means? It means that the interest amount is allowing you for the total Can you see that? Can you see at the end of 6 months, you now have a total of 160 Rand. Can you see that? That is what compounding means. Compounding means that you are actually doing and adding the interest onto. So I'm going back there. So this is compounding. Now I want to take you to simple interest. You're going to come across this term as we go along in the lecture. Simple interest is exactly the same model, except what does it do here? Simple interest means that your capital amount will always stay the same. Do you understand? They're not adding your interest on. At the end of it, you're only going to earn 10 Rand worth of interest for each month, and your total is going to be 160. However, I've used a smaller, here I've used, your interest is actually compounded. So here it would not be 10 Rand because obviously your interest is going to be increasing because can you see your?
Ma'am, are you
sharing your screen?
Yes, I'm sharing my screen.
I don't think anything on our side.
Okay, can you see now?
Yes, we can.
Okay. So look at the difference between compound interest and simple interest. Can you see that in compound interest, I'm just going to color this for you and draw arrows. So can you see from compound interest, it's moving there. Can you see what you've earned at the end of month 1 is what you're investing in month 2. So compound interest is telling you that you are reinvesting interest. You're investing interest and capital. That is what compound interest is telling you. Simple interest is telling you a totally different scenario. Simple interest is saying, all I do is I've worked out interest on 100 Rand that I've invested, and I will only be earning interest on the 100 Rand for the entire 6 months, which means I'm going to be left with my capital amount plus my interest. My capital amount was 100 Rand. Can you see that? Now, can you see the difference with the compound interest versus the simple interest? I've earned more on compound interest versus simple, 15 Rand more. Can you see the difference here? So if you're given a question and can everybody see my screen? Can everybody understand what I'm trying to say? You're obviously compounding, meaning you're adding interest onto the principal amount. For simple interest, you're not doing that, which is why it's called simple. Is everybody okay with this? Can I move on? Please give me a yes or a no.
Yes.
Yes.
Thank you. Now remember this as we go along, because you should not get confused, because compound interest will affect a lot of your calculations. And if you're given a question like this in your test or in any revision, remember, at the back of your mind, you'll always remember compounding is with regards to adding interest onto the principal amount. But who can tell me when compounding will not work? Who can tell me when compounding will not work? Who can tell me when this compounding will not work? What if the interest rate dropped here? What if the interest rate dropped here? And for some odd reason, you didn't sign an agreement with your bank manager to say you want a fixed interest rate. What if you have a varying interest rate? So what if this changed? And as the person said earlier, Oluwetu said that we would then, so then all of a sudden in month 5, you've gone back up to 10 Rand. And in month 6, for some reason, it dropped. What if you had a varying interest rate, and even though you're adding your interest to the capital amount, look at this. Can you see this? Can everybody see here the difference between my simple and my compound? That I'm actually earning more on simple interest than I'm earning on compound interest. Can you see that? Can you see at the end of your 6 months, you're actually earning less when the rate is changing because you haven't fixed the rate? Can you understand that? Does everybody follow on that? So compounding could work, because compounding could work. And as the person who said that we were in an inflationary economy, so say the interest rate was increasing every. So I'm just giving you examples. We're earning much more on compound on a varying rate as long as the interest is increasing. But if the interest is decreasing, we might not necessarily earn as much on compound. Please remember that in your test. The first thing you will look at is what? Whether it is fixed or, talk to me, whether the rate is fixed or
varying.
Yes, thank you. Let's get back to the lecture. Now I've explained to you a lot of the information here. Can everybody see my screen? I'm back to the presentation.
No, it's still on Excel.
Okay. Now,
Yes, we
Well,
can
we
now.
can say
thank you. So remember, I've explained to you what compounding is. Borrowing means that you either borrow money to invest of your own, which is called your own capital, or you borrow from the bank, or you take a loan, which is called debt. That you already know. I've explained to you what discounting means. Discounting is the reverse of compounding, isn't it? As Oluwetu said to us, discounting means you're paying less. Compounding means you're getting more, provided the rate is fixed. Am I right? Future value, it means what you're going to be earning in the future. Present value is what is the value of today's terms. Let's move on to interest. I've already told you what simple interest is. So without even looking at the definition, you can tell me simple interest is where you invest an amount. It is referred to as the principal amount, and then you incur interest on that amount only on the principal amount. So interest is not earned on the accrued amount. Accrued means, what does accrued mean? Think about it. I just explained to you. It just means an accumulation. When you see accrued, you must mean come back to just think that it's accumulated. It's increasing amounts. So interest is not earned on the increased principal amount. Remember that. Can I move through or follow through? So I'm not going to, you know the formulas here. It's your interest, your principal amount times the interest times the number of years or months. So remember, if it's 3 months over 12 months, whatever depends on what your question entails. Compound interest, you do not need to look at
Ma'am, can I ask a question?
Yes, yes.
Can you please go back to the previous slide?
Okay.
Do we always divide by 12 on the
No, that
time
depends.
frame?
No, yes, that's a very good question. Thank you for being attentive. What if you're given in the question that the interest rate, say for example, you as a student, you've invested 100 Rand for 3 months, and for that 3-month period, you're given an interest rate of 6%. Then you won't divide by 12. Then you won't, because you told in the question that for that 3-month period, you're given 6%. But what if you're given in the question that for that time, okay, you want to invest 100 Rand, but the lending rate per annum. So here, I'm just going to put here per annum is 10%. So that's when you look at your period. So let's do that here. So it's per annum. So then you're going to look at your period for which you have invested, which is say 3 months. It could be 6 months, 8 months, whatever. And then you're going to say, fine, my interest is 10% per annum. Per annum, you know, means per year. But I'm only investing for 3 months. That's when you take 3 over 12. Do you follow?
Oh, okay. Yes, I do understand.
Yeah.
Thank you.
So it's the same thing as you had to go to a bank. It's the exact same principle. If you look on your bank statement, and if you notice that they said to you that interest is, say, 3% per annum, 4% per annum, you'll notice that you earn very little interest on a simple interest account, even in a bank, like a student account. You actually earn interest in cents if you look at your bank statement, as opposed to compound interest. Now, before you look at this 3-paragraph sentence explanation here, you in your mind, you already know compound means compounding, accumulating one on top of the other. So when we're borrowing money, it's either going to be on debt or it's our own money. Now, I'm not reading this whole 3-paragraph to you. You can read it and you can understand it. But what I'm saying here in compound interest, it means that my interest is calculated on what I've invested, which is the principal amount, plus my accumulated interest portion. Can you see that? This is the main information that you need to understand for compounding. So it's money invested on interest. So you're earning interest on interest. Do you follow? Which is why it's called compound, and which is why it's more preferred. For example, when you are making repayments on loans, on banks, etc., they're always using compound interest. Why? Because when you take a bond out now, Remember, when you take a bond, or say, for example, you take a little student loan out, and the bank says to you, whoever you are, person A or accounts 103 student, I am going to lend you 10,000 Rand, but your interest is going to be calculated on a compound interest basis. Doesn't that mean that they're going to be adding interest onto your principal amount that you borrowed? So you borrowed 10,000 Rand, then they're going to add interest of 10% every single month. And your repayment of, say, maybe a minimal 200 Rand is first going to go against that interest, and then it's going to go against the principal amount. It means that the bank is making money out of you, isn't that so? Now, what is nominal rate? When we talk about nominal rate, we talk about a rate that is a quoted rate. So when you look at the word nominal, a nominal interest rate, all it means that the interest rate, that is a percentage increase in money that you pay the lender to use the money. So the adjustment of compounding is not taken into account. When you say nominal, nominal means it stays the same. For example, the bank quotes you a rate of 10% compounded monthly. The nominal rate will stay the same at 10%. It means it's the true, sincere value of that interest, right? So nominal rate means that it stays the same. It's the nominal rate. Is there any questions on the nominal rate? So remember, nominal rate means that there's no adjustments for inflation, nothing. So interest is as it is stated. Effective interest rate. Now, when we come to effective interest rate, what do we talk about? We talk about the rate where you take into account the compounding. Now, when we say compounding, remember, we're always referring back to those changing variables that change our interest. It could be the inflation rate. Remember, if you're getting a higher interest rate at the bank, why? Maybe because the government wants to encourage spending. So that comes from fiscal policy. It comes from monetary policy. So when we talk about compounding, we're talking about all those factors that affect compounding. So effective interest rate means so I'm just going to say, when we talk about compounding, you must remember in your mind, it's factors that change anything. So for example, when we talk about the effective rate would be the nominal rate plus or minus any inflation, any differences in the bank that they want to account for, which is why your effective interest rate, you will look, it has a different formula compared to the nominal rate. So can you see here, if I take you to the nominal rate, can you see it's 1 plus your interest rate, and then you subtract the 1 after that anyway? Can you see that? So the 1 actually has a very minimal effect on the nominal interest rate because you're adding 1 and you're minusing 1. Look at the effective interest rate. Can you see that it's 1 plus and then you minus 1 after that? And the nominal interest rate, you're actually taking your number of periods before that. The effective interest rate, you're not doing that. Can you see for the effective interest rate, you're not taking the number of compounding periods before that. So just remember, if you're getting confused, nominal interest rate means you're not taking into account any compounding. Now, what's the formula that we use when we want to understand the time value of money? If we're looking at a present value of a single cash flow, remember we said present value means the amount that it is worth in the current times. So this is your current day. And a single cash flow, it means a once-off. Taking you back to the slide, what did we say a single cash flow was? It meant a once-off cash inflow or outflow. So we know that it is once off. So what is your formula for your present value? You're going to take the future value all over 1 into 1 plus I to the power n. So this is your formula for the present value. For ease and simplicity of the course, you're only ever going to use this formula for the present value. So the present value means that you're taking that single cash flow, about how much it will be, and the future value into 1 over 1 plus the interest rate to the power n. If you're working out the present value of an ordinary annuity, the ordinary annuity, we know an ordinary annuity is what we pay monthly. So you will always start with payment all into 1 minus 1 over 1 plus I to the power n over the interest, where payment is the annuity that you're paying each month. So do you follow on the present value of an ordinary annuity? Now, I'm not going into too much of detail because the best way you will understand this is to use your illustrative examples in your textbook. Remember, the formulas stay the same. So in a test or in a revision, or when you're doing your revising for your tests or going over after the lecture, please make sure that you understand these formulas and you understand that this is a present value of an ordinary annuity, it's a present value of an annuity due, etc., etc. So present value of an annuity due, who can remember what we said an annuity due is? When do you pay it? Who can remember?
You pay at the end of each period.
At the end, or do we pay at the beginning?
Beginning.
Yes, you pay at the beginning, but it's calculated at the end. Can you see that? Let's go back to the slides. Annuity is where the payments are due at the beginning of the period. Can you see that? So you're paying in the first of each month, but when you're calculating it, you're obviously going to calculate it at the end of the month because you want to know what it's due after you have paid the amount plus the interest that's due for that month. So do you follow?
Yes.
So another way of thinking about it is saying that you're paying 100 Rand on the 1st of, say, for example, November. Now, how much is it an annuity going to be due on the 30th of November after my interest kicks in? So you want to know on the 1st of November, I paid in 100 Rand, my interest is going to be at 10%, but on the 1st, I want to know what I'm getting on the 30th. So you want to understand what it's going to be worth at the end of the period. That's what you call an annuity due. So remember, you payment in advance. Now we move on to the present value of a perpetuity. Now, if you look at this word, what comes to mind? Perpetuity means forever. It means you'll always be paying this. It's infinite. Infinite means that it's for a period that's undefined. So say, for example, you have a very kind and caring grandmother, and she's been paying a little amount that she earns after each month's salary. She's been paying for a perpetuity for your studies in accounting. She's been paying 20 Rand for the past 10 years. And obviously a perpetuity at any time you can stop it. So you can tell the lender or the financing house that you've stopped. You want to stop making payments and you just want the interest to accumulate on that last amount that it's been calculated on. So then you work out the perpetuity. Remember, it's a series of payments for an undefined period. You want to work out the present value. You'll take the annual return divided by the interest or the required return to get the present value. to find out that how much would you get today. So do you follow what a perpetuity means? All it ever means is, don't overcomplicate these definitions. All it ever means is that you have an amount that you wished to invest even for your children, etc., for an undefined period. An undefined period means that a period that you cannot determine the number of periods. And you want that same amount to accumulate interest each month. But say, for example, you've reached a point where you need to redeem that amount. So you need to then take the annual return that you would have got divided by the interest. Future value of a single cash flow. How do we work out the future value? This is very simple. You understand what it means. Future value of a single cash flow. You want to know what is going to be worth in the future, in time to come, of what is a single cash flow. We know a single cash flow is a once-off investment that you make. You want to know what the future value is. All you take is the present value into 1 plus I to the power n. That is a very simple formula. What do you want to know of a future value of an ordinary annuity? Remember, an ordinary annuity, we know that it's regular payments that you're going to be making. All we do is we take the payment. Can you see the differences in the future value? I want to take you back to the present value of an annuity. So if you look here, the future value of an ordinary annuity is your payment into 1 plus I to the power n minus 1 all over I. Remember, these formulas don't change. If you go back to the present value of an ordinary annuity, you take the payment into 1 minus I over 1 plus I to the power n over I. So if you look at the differences, let's copy this. So can you see the differences in the formulas? Can you see it's a reverse? Can you see that? Students, talk to me. Can you see present value is the reverse of future value? Can you see that you took the denominator and you put it on as the numerator? Can you see that?
Yes, we can see.
Okay, let's move on. Future value of an annuity due. An annuity due, remember we said you paid in advance. So you paid it in advance. So it's a series of payments that you would make at the beginning of the period. But if you want to calculate your amount, you calculate it at the end of the period. You will look at your illustrative example in your textbook on page 313. It's not a very difficult section. You will notice that there is a formula as well. Then now we move on to the repayment of a loan or an installment that is due. So you know that an installment means a repayment. Am I right? Debt means that you've taken a loan. It's repaid to the borrower. The installment debt is generally repaid monthly. It's on interest that's due. And we normally call it an amortization schedule. Now I'm skipping things here because I want you to understand what a loan repayment is. I'm going to stop sharing and I'm going to take you to an example of a loan repayment amortization schedule. Okay, so let's share my Excel. Okay, can you look at my Excel? Is everybody able to see it? So this is an amortization schedule of an ACC 103 student. Okay, so here we have the month, the capital. Okay, let's make this the month. You've got the capital. You've got your repayment. Sorry, let's put this there, and you've got your interest. Okay, you've got 1 month, month 2. Is everybody able to see my Excel?
Yes.
Okay, so you took out a loan from Capitec Bank. You've taken out a loan because you needed to fund your studies, and they've given you 10,000 Rand into your bank account. So I just want to draw a scenario here. So this is your bank account now on this side. So this is your bank account, eh? Just want to copy this. I want to show you something. So in month 1, you've got 10,000 Rand into your bank account. Okay, so you know that Capitec paid you a minus 10,000 because it moved from their account and it came into a positive into your bank account. Can you see that? Now, they've said to you that you are going to be earning, they're charging you interest at, say, for example, prime minus 1. What is the prime interest rate? Now, remember when I lectured to you previously, the first and foremost thing I said to you, make sure you understand what's happening in the market. Who knows what's the prime interest rate at the moment? The prime interest rate at the moment is 3.25%. So they said they're going to be charging you interest at prime minus 1.25, which means they're giving you 2%. They're charging interest on 2%. Now it's very low, but I'm just using it as an example. So you've now got, you borrowed 10,000 at 2%. Okay, and every month, accounting student is paying 10 Rand towards the loan. Can you see that? Okay, your repayment comes in there and the balance is there. Your repayment is going to be equal to the same thing. Okay, what do you owe Capitec at the end of the month? Can you see that? Can everybody see that? Look at this. You've invested, they gave you 10,000 Rand for your studies. They're charging you interest per month of 200 Rand. You're only paying 10 Rand back to them. Can you see how much you owe them at the end of month 1 only? You actually owe them more than you actually took out. And let's say, for example, this stays the same each month. So I'm just going to say, for example, it stays the same each month. Can you see that? If you're only making 10 Rand payments, at the end of the first year, you're actually owing them 12,000 Rand because you can see the amount of interest that they're charging you. Now, who can tell me something about the interest column? We've been discussing this. Who can tell me something about the interest column? They're charging you interest based on what?
Compound.
Okay, Oluwetu, I just used 10 Rand as an example. I just said that because you're a student, you must notice that banks will always give you the least amount to repay back. This is just an example. 10 Rand that you pay. So this 10 Rand is just an estimate. I've just given you an estimate. Because they know you don't work, and because they know you don't earn an income, and a repayment on a student loan is very low for a student. Now, students, look at this interest column. This is of significant importance. Look at the interest column. What is it? What can we say about the interest column for Capitec Bank? How are they charging you interest? Remember, we discussed the two ways you can calculate interest. Are they calculating interest? Look, for the first month they calculated it on 10,000. Okay, someone unmuted. You want to say something? No. The second month they calculated interest on the accumulated amount. The third month they calculated on the accumulated amount. So what is this interest based on?
Compound interest rate.
Yes, 100%. Thank you for that. It's compound interest. And this is what an amortization schedule looks like. This is what a loan schedule looks like. And then do you know where the game changer comes in? So let's say here, I'm putting a line under here. Now you're wondering, when is this loan ever going to be paid off? The game changer comes when ACC 103 gets an CFO position at Sasol Petroleum. So what happens here? Forgive my spelling. What happens here? Your repayments are going to get bigger, isn't it? All of a sudden, you've finished your studies. And your repayments have changed. So you finished. All of a sudden, the bank has now seen that you have, and now you go to the bank and you're able to pay 1,000 Rand each month. So I'm taking the same figures from the top, right? This is nothing different. This is month 13. I'm taking the same outstanding amount. I'm taking the same interest. And your repayment is 1,000 Rand. Can you see how your balance is being reduced rather than increased? Because your repayments have increased, because you're earning the Forbes top salaries because you're an FM. I just want to show you the difference. Can you see how your loan is depleting? Can you see that? Say, for example, you were paying 2,000 Rand. Can you see how quickly your loan has depleted? You now owe in Capitec at the end of 13, at the end of month 14, at the end of month 15. There you go. Can you see the difference now in how compound interest affects, and how your compound interest is outweighed now because you're actually paying more? Can you see that? Look at the difference in your compound interest here And look at the difference in your compound interest is reducing here, isn't it? Why is it reducing? Because you're paying more. This amount, the outstanding amount is changing. Can you see that? Compound interest is worked on the outstanding balance. As long as the outstanding balance is reducing, your compound interest is going to reduce. Can you see that? Look at this. Just in a matter of 6 months, you've managed to pay Capitec. You've got 1,515 Rand that's due. And all you would need to pay in the last month is your interest plus your outstanding amount, which gives you 0. Can you see that? Who does not follow? Or who follows? Tell me who follows. Or who wants me to go through it again? Who follows on what I've just done? Nobody follows. Students, talk to me. Do you follow or do you not follow on what a loan amortization schedule is?
I don't I don't follow on the last part. Yes.
The last part you don't follow. Okay. Do you not follow this part?
Yes.
Okay. Remember we said now, you were only paying 10 Rand interest, 10 Rand repayments. Because why? You were a student. So remember we started off by saying that you took a loan for your studies for 10,000 Rand. Capitec was charging you compound interest. So the student told us at the beginning, compound interest means interest on interest. Now, when you finished your studies, at this point you finished, you now have graduated and you've become a CFO of Sasol. What happened? You're now earning a salary, which means that you are now able to pay more into the loan from Capitec. So can you see it's the exact same amount at the end of your graduation year? It's brought forward into when you became a CFO. Can you see that? So Capitec is telling you, you still owe them 12,000 Rand because we were charging you interest for all that time that you were a student and you were only making 10 Rand payments, which means that we charged you interest. Do you follow?
Yes.
Now, you've become a CFO and you're earning a really good salary. And you know, as a finance student, I must pay my debt off first. So you started repaying Capitec. Instead of 10 Rand, you started repaying them 2,000 Rand. Each month, you want to get rid of this loan and you started paying them 2,000 Rand a month. Can you see if I take my outstanding amount plus my interest minus 2,000 Rand, it'll give me. So I'm going to take it. I'm going to take my outstanding amount. So let's do this. 12,548, because this is what I'm owing Capitec, plus the interest that they charged me. But I paid them 2,000 Rand because now I'm able to pay much more. Can you see now I owe them less? This is how I've got the 10,799. Can you see that? So for the next month, I take that 10,000 Rand and I add on the interest that they're charging me, which is 215 Rand, but I'm paying them more. I'm paying them 2,000 Rand. So now I take my 10,000 Rand plus my interest that I owe them. And I'm minusing my repayment. Can you see it's reducing? Can you see I now owe them only 9,000 Rand. So all I'm saying here at the last bit is that because my repayment is increasing, the interest is dropping. Can you see that? The interest is dropping because I'm owing them less. Here I was owing them more because I was only paying 10 Rand. Can you see that? Do you now follow?
Yes, yes, thanks.
Yes. So,
Ma'am, I have a small question.
yeah, sure.
Are we always given the interest estimation that we have to add,
Yes.
or do we have to calculate them?
No. You're always given the interest.
Oh, okay, thank you.
This is just a 103 cost. You're not required to calculate interest. You're always given the interest. Okay, there might be your textbook examples which maybe take you a little bit further, but for this part of the course, you're not entitled to calculate the interest. You'll always be given the interest. Now, can you see how an amortization schedule works? Amortization, you know what is amortization? Amortize means to divide. It means to split up into little parts, bits and pieces. That's why we're splitting it. Capital, interest, repayment, balance. That is what amortize means. It means to split it up. So I'm going back to the lecture slides. Now you can see why I didn't speak to you a whole mouthful here. When you look at an example, it actually puts it in perspective. So you have an installment, which was the repayment. It's paid monthly. Remember, I showed you, you paid 10 Rand while you were a student, and then you started paying 2,000 Rand when you became a CFO. It's amortized. It means that it's split up, it's divided into an amortization schedule. It's the schedule I just showed you so that you can understand the payments throughout the duration of the loan. You follow? That is what a repayment schedule is. The amortization schedule will show you how much your loan reduces or how much your loan increases throughout the period, and how much goes towards the interest and how much goes towards reducing the capital. I just showed you that. So I showed you that as long as you make very little payments, your loan amount will always increase. And when you increase the repayments, your loan starts decreasing. It makes common sense, isn't it? Because when you take a loan out, you want to get rid of that debt. So you want to add more money to that repayment. And then once you start adding more money to that repayment, your capital outstanding automatically decreases. Any questions? We've come to the end of today's lecture. I hope I've put it in perspective for you. Do not overcomplicate the section. Do not overcomplicate anything when you're doing your examples. Bring yourself back to day-to-day activities. Bring yourself back to real life scenarios. If you've had to invest, if you had to take out a loan, what would it mean? And then do your examples. Are there any questions? Today's recording will be put up on To Learn after today's lecture. If you have no more questions, you're welcome to leave.